From New York City, for our viewers worldwide, I'm Vonnie Quinn. Bloomberg Real Yield starts right now. Coming up, January payrolls showing a slowdown in job growth, an increase, though, in average hourly earnings. As U.S. consumer sentiment falls to a 7-month low on inflation concerns, giving the Fed and Chair Powell plenty to chew on ahead of his testimony on Capitol Hill. We begin with a big issue, a moderating yet healthy labour market.
When you put it all together, it's like, boy, it's hard to debate that you've got a solid employment report.
It's another sign that the economy continues to be really resilient.
We've been saying that the labor markets have been holding up pretty well.
The labor market in particular has been much more resilient than I think most people anticipated.
Is this the best labor market that we've ever had? Probably not. It's slowing, but it's still darn good.
And I don't see any signs of an economy overheating.
So overall, the economy seems to be on good footing.
The tailwinds to growth continues to be very strong.
The Fed's on hold, right? They are totally on hold right now. They're on ice. They may not move at all this year.
The Fed's in a wait-and-see mode. The market's in a wait-and-see mode.
What the market's telling you is we're on hold at the Fed for an extended period of time.
The lean is toward, but let's see what happens.
So let's recap some of this morning's data. So you had non-farm payrolls, which came in below estimates, but not too far below, right? 143,000, not too shabby. The unemployment rate ticking down to 4%. We also had average hourly earnings up 0.5%, and the participation rate ticked up as well. So quite the strong jobs report. Then we got University of Michigan sentiment data, and that showed sentiment decreased, and it was mainly thanks to inflation expectations. A big wow number in that one-year inflation expectations, 1 full percentage point higher than last month's and also than the expected numbers, so coming in at 4.3%. That's where the respondents feel inflation will be in 1 year time. In 5 to 10 years time, that was also a tick higher than expectations. So spooking the market just a little bit. Let's have a look at the 10-year yield. It's been in focus all week, and this is what you had today. You had, after the jobs data, the 10-year yield putting on maybe 5-6 basis points. Not the craziest of moves, but at the same time a very significant move in terms of symbolism, let's say. And then after the Michigan data, we topped that dreaded 4.5 mark. Not too far past it, and we've come back down just a little bit, but that's not what Scott Bessent wants to see. The Fed, though, as Neil Dutta says, it's not in a very forgiving mood. This all gives the Fed potentially a reason to just keep calm and carry on.
One of the things I wanted to emphasize is that we are not focused on whether the Fed is going to cut, not cut. What we are focused on is lowering rates. So we are less focused on the specific rate cuts and how do we get the whole curve down. I mentioned that the 10-year, I believe, is the important price to focus on. It's mortgages, it's long-term capital formation. So, and look, I think with the president's policies of energy dominance, deregulation, and non-inflationary growth, I think that the 10-year is going to naturally come down.
Joining us now, George Catrambone, head of fixed income and trading at DWS Group, and Anders Persson, CIO for global fixed income at Nuveen. George, I'll start with you. Thanks for joining. This move today, while it's not the largest move we've ever seen, it was pretty significant symbolically, right?
Very much so. And I think unemployment rate coming down and inflation expectations going up, that's the Fed kryptonite. That's long end kryptonite. And it really comes down to uncertainty. The market is uncertain and uncertain about tariffs. And that's going to be the story throughout the year as to where we go from here and where actually rates go in the short and the long term.
Anders, this move, 5-6 basis points in the 10-year, it's not what Scott Bessent wants to see, but at the same time, the data rule, right?
Yeah, for sure. No, there's no question that the jobs numbers were stronger than expected, and the economy is holding up really well. So that's really, what the market is reacting to, and I think we're expecting sort of more or less of a range bound, particularly from a 10-year for the rest of the year. 4.5 plus minus 25 basis points. Now, maybe where we can see a little bit lower movement at some point would be more on the front end, maybe the 2-year. We're expecting, still, potentially some cut from the Fed during the year, depending on economic data, definitely around Trump kind of policies going forward. So if we do see that, we could see the 2-year moving a bit lower, but the 10-year we're expecting to be very anchored around current levels.
Anders, does this change anything on the margin, this data? So yes, we saw the move today, but is it the case that the market is waiting to see what ends up happening with tariffs in order to sort of find a spot to settle on? And I mean, are we ever going to get that? Isn't the threat of tariffs always going to be there?
Yeah, I mean, I would say today's data, or even this week's kind of type data for and information overall, it was a pretty wild week in general. I would say it hasn't changed our views perhaps all that much. I think it's reinforced our view that the economy is holding up really quite well. It's reinforced our view that this higher for longer kind of backdrop for rates is going to continue for some more time. I think it's reinforcing that Fed can be really quite patient and doesn't have to move anytime soon. I think on the tariff side specifically, I think we've been expecting a fair amount of discussions, but maybe not a lot of details. And I think that's what we're ending up seeing right now. There's, a delay now with with Mexico and Canada, probably a bit lower kind of focus on China than expected originally. So I think the market's going to have to be a little bit patient as well to see really what the details are. So yeah, I think it's going to be some time before we have true clarity between the economic data and ultimately what the Trump policies will be.
George, does this labour market report irk the Federal Reserve in the sense that there's really nothing that's all that bad about it, but there are things that could be potentially inflationary?
And they're completely in wait-and-see mode. They're going to say, don't call us, we'll call you. In fact, we're not going to hear from them again until after St. Patrick's Day, in fact. So there's going to be more prints to come, and I think they're going to want to see a CPI print on there to see if expectations actually turn into reality for inflation. But for the moment, maybe 2 cuts this year, maybe 1, and it certainly keeps them on pause for the moment and more attentive to continued data.
That's March 17th for anyone who doesn't know out there. So what do you do in a situation like this? Because last year there was so much volatility in fixed income, and yet at the end of the year there was really nothing to show for it.
Stay invested. I get more calls and got more calls when rates were down at 360 than I did at 480. And everyone was asking, did I miss it? Are we still long? So that FOMO will present itself, especially as rates start to come down. But the premium that Anders was talking about is being expressed in term premium and higher rates and more volatility in the short term. So I would say to all the listeners out there, stay invested.
Invested where, though?
Yeah, specifically when fix them in bonds because of the all-in yields that you're getting. You're getting between 5.5% and 7% for not having to go too far down the credit stack and take undue risk. So it's a great time to be a fixed income investor.
Sure. So Anders, have you any more specific advice for anyone out there that has a little cash to put to use?
Sure, yeah. I would say we're less excited about the rate side. As I mentioned, we think there's going to be more range bound for the year. We prefer to express our views more in the credit and securitized space, both on the public and the private side. Again, this higher for longer backdrop really makes us more excited about some of the floating rate opportunities like leveraged loans, CLOs, we think still is offering attractive value. Even parts of the private credit opportunity, which is also floating rate in general. I think also, to George's point, use the full kind of opportunity set within fixed income. Securitized credit, for instance, is where we're still finding some dislocated opportunities. In CMBS, for instance, we are starting to see a little bit of a turnaround from a real estate backdrop. There are areas in the asset-backed security space, particularly around esoteric areas, and particularly playing some of the digital infrastructure opportunities. We talk a lot about AI, a lot of need for data. That can be expressed in a lot of different ways away from the equity markets within fixed income as well. And finally, on the municipal side, there are plenty of opportunities there, particularly if you're a tax equivalent yield kind of type investor. So basically taking full advantage of the opportunity set, and we really like the yield opportunity here at this point.
Yeah, that's a lot of areas actually that you're very positive on in the market. I'm just curious if there's anything that could, knock you to the sidelines in any of those areas, any particular concern that things might go haywire in some sense. We have a lot to come. We don't know what exactly is going to happen with immigration. We don't know what's going to happen with extending tax cuts. We don't know what's going to happen with tariffs for that matter.
Yeah, I think as you probably could tell, my theme there is a little bit more floating rates. We're a little bit less excited about, more rates-driven opportunities, so treasuries and rates in general. A little bit less excited about parts of the credit spread market like high yield and IG, particularly IG, where we think spreads are pretty tight at this point. So we could see some spread pressure if we have some of these uncertainties that you're referring to. So diversification very key in my mind. But if I go back to what we talked about a second ago, economy is holding up really well. So going down a little bit below investment grade, but staying more floating rate is still the broad that we're implying at this point.
George, I know you agree. You say avoid high yield products. So you want to stay invested, as you say, but avoid high yield. And you particularly like service sectors.
I do. I like industrials, and I love financials and banks. This deregulation, if it actually comes to fruition, and I think Bowman was out yesterday talking about further deregulation from banks. This is a great time for financials and even super regionals here to take some additional market share. So we like that sector a lot.
All right. Well, thanks to both of you. We will check in with you again very shortly. That is George Catrambone of DWS Group and Anders Persson of Nuveen. Up next, the auction block. IBM this week with debt sales on both sides of the Atlantic. This is Real Yield on Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield. Time now for the auction block, where after a slow start to the week, credit issuance definitely picked up. We start in Europe, where we saw a few so-called reverse Yankee sales. IBM, T-Mobile and Parker Hannifin all with deals. Spread tightening for all three suggested that investors' bids were strong. IBM was also part of this week's U.S. high-grade issuance, along with notable sales from Pepsi, UBS, U.S. Bancorp and Foundry, which is a joint venture between Intel and Brookfield. Weekly volume was around $40 billion, topping estimates. And over in high yield, issuance so far for February is 50% higher than a year earlier, with more than $8 billion worth sold. You had deals from the likes of DirecTV, Jane Street, Cleveland Cliffs and Hess Midstream. Speaking of credit, Danielle Polly of Oaktree says elevated rates have opened up major opportunities.
Today, given where we are in the interest rate cycle, it's an incredibly attractive time for credit. So elevated rates are a tailwind for credit investing. They only increase the yield that investors can earn.
Joining us now are Amanda Lynam, Head of Macro Credit Research at BlackRock, and Meghan Robson, Head of US Credit Strategy at BNP Paribas. Thanks to you both for coming in. So I'm just curious, we've been watching the dynamics over the last few weeks. Did today change anything for you? I mean, just this 5 or 6 basis point move that really hasn't gone away in the 10-year and across the curve, really.
Well, thank you so much for having me, Vonnie. It's great to be here. I think from our perspective, we still have a really constructive outlook on corporate credit. But as we've been emphasizing over the past really a couple weeks, you just really need to be very clear about why you're buying credit in this environment. I agree with what Danielle said. Actually, the yield income carry opportunity in credit is really attractive here. That said, spreads are pretty tight. We wrote this week that we do expect some modest widening in spreads, but I would say it's very, very moderate compared to the broader context. And that's really supported by a range of factors: strong growth, favorable technicals. The data from this morning in terms of the employment backdrop, still pretty solid. So I think the Fed is really in a position where they're not going to be cutting at least until the second half of the year. We may have some volatility around headline risk, but we still like credit from a core portfolio perspective.
And Meghan, you know, just to move it over to you, global credit spreads, as you've been pointing out, haven't really changed all that much since the election. I mean, we've seen a lot of volatility, but not, you know, huge overall change.
Exactly. Well, thank you for having me. If you go back to the election, looking at IG spreads, they've been trading in a very narrow band, just 7 basis points. So there are some expectations that the change in the presidency, things like tariffs, could cause volatility in credit, and they have in other asset classes, but we expect and have been actually quite stable. So we expect sort of this environment of shallow dips, low but positive returns for credit to continue. And as Amanda pointed out, we think things are in very good balance in the technical picture. So yes, we have seen a lot of supply, but yield buyers have come in. And so we think that credit now offers very compelling carry, and most of our trades are centered around that theme.
Amanda, there is that volatility, though. Is it tempting to lean into it?
Yeah, I mean, I think actually most investors would welcome that sort of backup as an opportunity to deploy capital. What we've seen really over the past year and a half, and this was even true in the August volatility in the corporate credit market, those dips are bought very quickly. So high yield spreads in particular tried to widen in August in a sustained way, and actually there was buying on the other side of that. And so I do think that that would be a welcome development. We hear from our conversations with investors that many of them are kind of having some capital, dry powder on the sidelines to deploy into this market. But I think what's important is to capitalize on those opportunities when they materialize quickly, because they do tend to be short-lived. I think from a broader perspective, what's really important in this market too is creating portfolios that can weather a range of scenarios. So incorporating floating rate exposures, different points of duration. We tend to favor shorter duration at the moment, real assets, alternative assets, for some inflation hedges. I think that's a really smart move in this current environment, because really there are a lot of different paths on the probability tree, so to speak, in terms of where things can go.
Well, so on that point, with the threat of tariffs on and off the table, and even, you know, if one or the other pans out, that doesn't stop the threat, right? The threat could continue on after that. The tariffs might be upped, or they might be taken away. Or how do you decide what you should avoid in order to avoid all of that uncertainty?
So I think for two things I would say. One is any given policy proposal needs to be considered in the broader context of the policy priorities. So we have certain issues like tariffs, which are top of mind right now, but we're also looking for potential tax cuts, deregulation, and so that needs to be considered in the broader suite of policy priorities. I think from our perspective, just like we've been focused on companies that can withstand a high rate environment, that have the ability to really weather a whole range of economic outcomes, we're really focused on building portfolios that can weather a range of scenarios. One of our taglines, which we still believe in, is dispersion but not widespread market disruption. So I do think that given the shifting tides, you may have certain sectors that are more exposed, but we're really trying to build portfolios that have long-lasting potential. Financials was mentioned in the earlier segment. That's also a sector that we like in particular. I think there's a range of tailwinds behind that as well.
And Meghan, you know, you look at credit globally, you know, most of the time.
Yes.
We got a headline just a little while ago. President Trump, who was speaking with the Japanese Prime Minister, you know, mentioned to reporters that he will be announcing reciprocal tariffs next week. Look, we've heard that he's going to be announcing more tariffs, and we know that that's something he likes to do. We're not quite sure who he's reciprocating at or who this might mean yet, but potentially Europe. It could be, you know, China again. Yes. What do you do in a situation like this?
So I think that in aggregate, tariffs should be manageable for credit. And we look at a few things to measure that. So I think direct sales exposure of U.S. credit issuers to abroad is manageable, and also supply chains. We are integrated globally, but issuers have done a good job of diversifying those. So in aggregate, we think credit markets can handle tariffs, but there will be a lot of headwinds at the sector level, and we don't think those are priced in. So we track something called a tariff risk premium. This looks like at a basket of very tariff-sensitive names. That premium right now is only 15% of what it was in 2018 or 2019. So there's a lot of room for more risk to be priced in. In terms of where that could be, we think investment grade autos is one place. So very integrated supply chains with Canada and Mexico. I think high yield building products, another area where we're a little bit more cautious. If you were to see lumber tariffs, for example, or on steel, that sector could face headwinds. And then on the other side of the coin, we like services sectors. So places where you don't have that goods exposure is a good place to hide out.
We heard that from George just a few moments ago. You said the premium isn't quite built in, or maybe it came out of the market a little while ago. Neil Dudd, I remember talking about geopolitical risk potentially coming out of the market maybe a week ago. If the premium isn't, excuse me, large enough, what should it be?
So we think that there could be a repricing just of those individual sectors. And of course, we'll have to wait and see where the tariffs are implemented. So the autos trade, for example, I think that premium could grow if tariffs tend to focus more on Canada and Mexico. On the other hand, if tariffs are more centered around China, then we think that other sectors such as building products would be more vulnerable. So I think you really have to be dynamic in terms of how you position based on what type of region is the focus.
Amanda, what will China do next, and does that impact how you invest?
Well, I think in general, what's really important for corporate credit investors is global growth and specifically U.S. growth. So the one I would say area that we're watching is what is the intersection of all of these different policy priorities, whether they be trade, deregulation, taxes, and what does that mean for the backdrop for growth? Right now, we are well above trend. So we're at a 2.9% U.S. real GDP, according to the Atlanta Fed Now GDP tracker. There's a lot of scope, actually, even for growth to decelerate, but still remain either at trend or above trend. And that's really what matters for corporate credit. From our perspective, we are expecting around 10 to 15 basis points of widening in IG, around 30 to 40 basis points of widening in high yield at the index level, but that would still leave us well below the post-financial crisis averages, and I think that's a reflection of the strong growth momentum behind corporate credit.
I have to thank you both. Thank you so much. We could continue this conversation, but we do have some more headlines from the president that we want to bring you. First, our thanks to BlackRock's Amanda Lynam and Meghan Robson of BNP Paribas. So to these headlines then, President Trump obviously speaking to reporters as he was meeting with the Japanese Prime Minister, saying that he hasn't changed his mind on the US Steel, Nippon Steel deal. And I just want to point out that we have the yen weakening as well as we're getting these headlines. So the president hasn't changed his mind on US Steel, Nippon Steel. We have Trump not needing the US in Gaza. So he's saying that perhaps his plan could be carried out without US troops actually in Gaza. And auto tariffs are always on the table. He says he'll be talking to President Putin, and he also says that he will be meeting with Prime Minister Xi probably very soon. So those are some of the headlines just now coming out from the president's meeting with Ishida. We'll bring you more in just a few moments, including market reaction. This is Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield, and it is time now for the final spread. And the week ahead, coming up, well, of course, the week is kicking off really on Sunday, isn't it, this year with Super Bowl? I don't know if you're an Eagles fan or a Chiefs fan, but definitely a Kendrick Lamar fan, so we'll stick with that. That's probably the safest. France AI Summit, that's starting to get underway. We might get headlines that might tell us more about where we are in that particular cycle. Tuesday, we have Fed Chair Powell starting his testimony to Capitol Hill lawmakers, and then we also continue with earnings, which, by the way, we're more than halfway through now, but we do get some big ones. Coca-Cola, Kering and Marriott. Wednesday is another big one. We get CPI data. We will be watching that extraordinarily closely. Of course, Powell continues his testimony on that day. It's to the House. And then all of those earnings, you have CBS, you have Robinhood, Reddit, for example, another big one. Thursday, of course, you have those raft of earnings as well. Honda and Nissan will be a big one. And also Trump and Modi are expected to meet. That is Thursday of next week. And of course, Friday is Valentine's Day, when we do absolutely nothing. No, I'm just kidding. I guess retail sales and Valentine's Day are associated, are they? I don't know if they are anymore. We also get earnings from Hermes. And so my final thought is that we will be absolutely watching the CPI data next week for more clues as to what the Federal Reserve should do, how strong the economy is, and whether we're making any more progress on inflation.